The basics of stock market investing. What we'll be covering, first we'll give an overview of how financial markets work. We'll talk about the fundamentals of portfolio management. We'll describe the type of stocks that you can buy on the market. We'll talk about exchange-traded funds, dividends that you can earn by owning stocks, recent development in the main financial markets, a few tips if you want to go further, and we'll end the webinar by describing the Bourstad platform and the 2023 Bourstad Challenge. If at any time during the presentation you want to ask a question, you can use the discussion features to ask your questions. And I'm here with Mrs. Bourget of CIRANO, which is responsible for events and communications. And Mrs. Bourget will either ask me the question during the presentation if it's really on topic, and there'll be a Q&A period at the end of the webinar. So let's first give a look at how capital markets work. On one side, you have the capital users, all these organizations and institutions that will need capital to invest, to perform some type of investment. And on the other side, we find capital providers. Between capital users and capital providers, there must be first a primary market. The primary market is the market on which securities are first issued. And when this takes place, the capital users will receive the proceed of an issue of capital, and the providers will receive the securities, the corresponding securities. So who are capital users? First, you have the governments. They need capital to build roads, hospitals, and they perceive taxes, and these taxes are used to reimburse their borrowings. We also find other types of public organizations like public utilities, universities, hospitals. All these types of institutions may solicit the capital market to get the funds they need to build their premises or to buy equipment, expensive equipment. Then we can go and look at private corporations. First, we make a distinction about the corporation in the financial service industry, because mostly these corporations will come to the capital market to get funds that they will use to lend money to either individuals like you and me, or to firms that just go to the bank to get money to invest in what they want to undertake. On the side of the capital providers, we see that we have many types of institutional investors like pension funds, insurance companies, banks, credit unions, investment funds. We can have central banks. Normally, central banks are not really capital providers, but they have been doing exactly so since a few years, when they entered policy of very easing money, easing the financial condition on the markets by just buying mostly bonds from government bonds on the market. Well, when they do that type, normally they buy on the secondary market, but it may very well be recent bonds that the government recently issued. So they're not exactly on the primary market, but quite close. And government also manage sovereign wealth funds, like in Quebec, we have the Fonds des Générations, but many countries like Norway or Saudi Arabia or even Alberta, they also have these types of funds in which they invest money that may be money like for Norway or Alberta, that was just money that they collected from taxes on energy firms, and they just wanted to invest these huge funds in a way to get benefits for future generations. And finally, you also find individual investors that can buy into the initial issues of securities. They are the first buyers of these securities. So anytime a security appears on the market, first appear on the market, it is sell or sold on the primary market. When owners of issued securities want to sell these securities, they have to go on secondary markets like the exchange, like the Toronto Stock Exchange or the Venture Exchange in Vancouver, or in the US, that would be the New York Stock Exchange or the NASDAQ. All these stock exchanges are part of the secondary market. This is where capital providers trade securities among themselves once these have been issued. Okay, let's talk now about investment objectives. So these objectives, which are determined by each individual taking into account his or her personal situation and the general conditions of the investment markets, these objectives describe what one hopes to gain by investing his or her money. So these objectives are income, want to get some regular money from the investment in the form of dividends or interest income. We can also talk about capital appreciation. It means what you have invested in will grow in value as times go by. And you also have capital preservation, meaning that you just want to get your money back when you don't want to own the investment anymore. And finally, we can talk about liquidity. So let's say a few words about each of these objectives. Capital preservation. Capital preservation is the legal, moral, or conditional guarantee that the investor will be able to recover all of his capital and receive the expected income. So that's capital preservation. The higher the return sought, the lower the security of the capital or the safety of the capital. Here we have a continuum of low risk and low return securities, and all the way to high return, high risk. So certainly a bank account in a Canadian bank, protected by the deposit guarantee, is very safe, but very low return as well. Is investment certificates a little higher, government bonds, corporate bonds, preferred shares, income properties, real estate, common stock, precious metal, options, all the way up. Here I must mention that we do not take into account what happens when you build portfolios. When you build portfolios by mixing these different types of securities, the risk of the resulting portfolio will differ. It will not be an average of the return and the risk of the different type of asset classes, because diversification produces its own benefit. We'll talk about it in a moment. Okay, investment income. Investment income is one of the financial benefits of holding investment that take the form of regular periodic payments. Well, this is what you get with interest income that you earn on guaranteed investment certificate and bonds issued by government or corporation. You also have investment income with dividend. The dividend is how we label what you earn from a common or preferred share in a company. If you invest in real estate, you would then get rental income. Capital appreciation. Investment appreciation is a goal that is achieved when more capital is returned to the investor upon disposition or sale than was originally invested to acquire the investment. The liquidity of the investment. Liquidity of an investment is characterized by how quickly it can be converted into cash without incurring a loss due to the rush to dispose of it. Let's now look at how you read a stock market quotation, and we'll get back to liquidity on the next slide. First, we have the quotation of Metro, the large food retail distribution retailer, food retailer in Quebec or in Canada. In fact, Metro has stores in other provinces as well as in Quebec. So here we see that Metro today, February 7, this morning, the bid was $69.74. So someone was offering 69.74 cents to buy stocks in Metro. And some other guy or investor, in fact, was demanding 69.77 cents to sell Metro shares. Here we see that we have a difference of 3 cents, which based on the price of 69.77 cents is not a lot of money. It's very small percentage for the spread between the bid and the ask. May also look at some other information on this slide. So Metro is currently paying 30.25 cents as dividend per quarter. So it is paid 4 times per year, and it amounts to 121 cents as dividend per year. This represents a yield of 1.6% per year. So $1.21. If you are paying $70 to buy a share, it is 1.6% return per year for the dividend. Okay. Let's look at another quote for a smaller corporation, Urban Immersive Incorporated. Here we see that the bid, someone is ready to buy at 26 cents, and the seller is asking 32.5 cents. Here the difference is much more important. In fact, it's 6 cents compared to Metro 3 cents. You may find that it's not a big deal, but 6 cents based on the price of 26 cents or 27, that's something like 20%. So the difference between the bid and the ask is huge here. We may say that urban immersive is not a very liquid stock. In fact, no shares had been traded well, I took that quotation at 10 o'clock this morning. It was right after the Metro quotation. In fact, we were at 10:30. So the market had been open for 1 hour and no stocks had been traded yet when I got this quotation. So not very liquid for a stock. Okay, let's talk now about portfolio management strategies. We'll talk about 4 strategies. First, portfolio diversification, fundamental analysis, technical analysis, and we'll talk about active versus passive management, portfolio management. Okay. First, portfolio diversification. Portfolio diversification is to seek certain benefits, such as higher returns or lower risk, through a certain mix of securities within a portfolio. These strategies are often based on portfolio diversification, meaning the inclusion of securities from different industrial, geographical sectors with different degrees of risks. Okay, here we have a chart about the return that could have been obtained by investing 200,000 Canadian dollars on January 1st, 1993 for 20 years. So until January 1st, 2013. Okay, and we can see different asset classes and how they perform during that 20-year period. We see that the Canadian Treasury bills, which Treasury bills are short-term bonds, 3 months bonds issued by governments. So we started with 200,000 Canadian dollars, and at the end of 20 years, we had accumulated $276,000. Not much, in fact. Low return. If we want to have the highest return on this period, it was with Canadian equity, Canadian stocks. We ended the 20-year period with more than 800,000 Canadian dollars. If we had invested in US equity, US stocks, they were once quickly, US stocks returned a very high yield. In fact, first, out of the gate, after a few years, you already had accumulated more than 750,000 Canadian dollars. So that was quite a lot of money. But first, there was the tech bubble that imploded. And then there was the financial crisis in 2008. And at the end of the 20-year period, you had accumulated a little more than 500,000 Canadian dollars. If you had invested in gold, well, for many years, gold didn't perform very well. But when we got to past the 2005, it increased quite quickly and ended also above the 500,000 Canadian dollar mark. If we look at the Canadian bonds, first we see that the ribbon, the green ribbon, is very stable. and also offer over the 500,000 Canadian dollar mark. We also can look at what we call a diversified portfolio. It's a portfolio made of 10% of treasury bills, 30% of Canadian bonds, 30% of Canadian stocks, 20% of US stocks, and 10% of gold. So this diversified portfolio ended with approximately 650,000 Canadian dollars, the second best portfolio of the pack, and was rather stable along the years. Okay, let's look at the next slide. The next slide just shifts the period by 10 years. So we invested on January 1st, 2002 until January 1st, 2022. And then again, we can see that the diversified portfolio was very stable and, well, satisfying because we produce a little over 500,000 Canadian dollars. But it's something surprising. The best portfolio now is gold, with approximately a little more than 700,000 Canadian dollars, followed by US stocks, Canadian stocks, the Canadian bonds that did very well 10 years before are not so good now. And the treasury bills are still lagging. In fact, you will end with less than 200,000 Canadian dollars if you had invested in T-bills for that 20-year period. So we see that the diversified portfolio is rather stable on both slides with a nice enough return, and all the other types of assets perform differently between the first and the second slide. And if we were to look at the 20-year period starting today, it's quite hazardous to tell which asset class would perform the best for this additional 20-year period. But we can be quite sure that the diversified portfolio would still give us a nice trade-off between risk and return compared to the other possibilities. Okay, so that's what we call portfolio diversification. Okay, another type of strategy would be applying fundamental analysis. Fundamental analysis scrutinizes the financial situation of companies or projects concerned in order to be able to make a reasonably reliable forecast of their short and medium-term earnings prospects. The basic information for this exercise is found in the annual report, in the financial report of firms. This can be found on the company corporate website, normally in a section labeled Investor Relations. But many financial sites like Yahoo, Quote Media, Morningstar will provide you with this type of information in a standardized way. So here we have a look at Quote Media, I believe. That is the provider of financial and market information on the Bourstad platform. The scope of fundamental analysis is not limited to companies. We can also analyze the whole economy with fundamental analysis, or a particular activity field or industry sector. Technical analysis. This approach to investment value is based on the analysis of investor behavior. Advocates of this approach will compare the movement in investment prices to the movement of waves on a rough sea, something that you can see if we look at the metro chart for 5 years, I believe. It's a bit like waves on a sea. When a stock has risen significantly over a short period of time, the market for that stock will generally move downward. The reverse also occurs in the case of a value that has fallen sharply. After a sharp fall, a rise will probably happen. Active portfolio management. Active portfolio management consists of using different methods, such as fundamental analysis, technical analysis, to build an investment portfolio for which the goal is to outperform the market index. You want to do better than the market. So that's active portfolio management. Compared to that, passive portfolio management will take a much simpler approach by simply building a portfolio that will closely track the performance of the market index. You can easily do passive portfolio management nowadays by buying into exchange-traded funds that are built to track very closely a market index with a low fee. In fact, you can have fees as low as 0.10%, for example, 0.25%. Though that's quite low compared to what we used to have in the past. Management fees were much more in the 2 to 3% range in the past. Okay, let's talk about responsible investment or sustainable investment or investing. Different type of investment strategies that you can rely on. That would be screening. Screening can mean you just avoid some sectors entirely. So maybe you will not buy manufacturers of cigarettes, tobacco firms, or you may avoid the defense industry, firms that build for military usage. You know, so you may just avoid these type of activities altogether. Or maybe you can screen by maybe entering some type of, let's say, not so recommendable activities, but by trying to filter the firms that have a better, let's say, ESG record, environmental, societal, and governance record among the firms of this particular not so recommendable industry. Active shareholding meaning that you will, in fact, invest into firms, but you will try to bring this firm to amend itself by participating to the assembly of shareholders and bringing some proposal to the assembly so the firm could just change its behavior. And solidarity investment means investing maybe in microcredits, for example, or in, let's say, workers' funds, funds that invest in a way to preserve employment in some industries, in a way to create jobs in those firms. ESG factors, environmental risk, social risk, corporate governance risk. So these are the extra financial risks that you may look at when you manage your portfolios, trying to avoid the firms that have too much risk, either for environmental factors, social factors, or governance factors. We can also talk about some industrial strategies about sustainable development, like the clean tech clusters that we find in large Canadian cities, Montreal, Toronto, Vancouver. There's also the concept of circular economy. If you create an account on the Bourstad platform, you have the opportunity to download the guide to investment, to sustainable investing that we make available to users of the platform. Degrees of involvement you wish to have in the management of your financial assets. Maybe you want to go to private management. So private management is done by 3.2% of households in Canada, but it means 60% of assets under management. That's a very large part of assets under management. Maybe you want to delegate management to a share portfolio manager. That's what you get when you go to investment funds, actively managed, or if you have an investment advisor that has a license to create portfolios, and this advisor will invite you to buy into these portfolios that he or she has created. You can also have an account with a full service broker, and this broker will just guide you in the selection of securities that will make up your portfolio. Finally, you may decide that you'll be an autonomous portfolio manager, and you just have an account. You create an account with a discount broker, or you may opt for services like robo advisors that these brokers can offer. Okay, what are the fees and the entry thresholds? For private management, you would normally talk about at least 500,000 Canadian dollars, and the fees would normally represent less than 1% of the total amount invested. For share management, the amount is much lower, $25,000, and you may expect to pay between 2 or 3% of that money as fee to the manager. If you have an account with a full service broker, and you will select yourself the security, you will select the securities, you will not buy into funds. So that would be more like 50,000 Canadian dollars. And then the fees will be approximately the same, between 2 and 3%. For autonomous management, $10,000 is probably enough. If you have a portfolio with more than $100,000, the fees will probably be less than half a percentage point. And if you have a $10,000 portfolio, your fees could be more like 2%. Okay, let's look at what types of action you can buy in. First, we'll look at the classification according to legal aspects, and then a more significant one, I believe, according to expected benefits. So based on the legal aspect, we can talk of common shares and preferred shares. Mostly on the markets, you must know that we will find common shares. Preferred shares are maybe something like 10% of the whole market, and are more like bonds, or bonds are not exactly, you're not an owner of the company when you buy a bond. You have lent money to the company or to the government. So the preferred shares are more like bonds than common shares. So common shares can come with one or multiple votes, or they might be non-voting common shares. Might seems like something impossible, but in fact that exists. And preferred shares, they can be with cumulative dividend. It means that if for one reason or if for any reason, the company has to interrupt the dividends on the preferred shares, when the dividend will resume, they will pay the arrears will be paid, so we call it cumulative dividend. The dividend can be a variable rate. Normally it's fixed on the preferred share, but you could find preferred share with a variable rate dividend. The preferred share could be redeemable upon request by the holder, or they could come with a repurchase clause for the issuer. Could be exercised by the issuer. He could decide to just repurchase the shares, and the price at which he proceed is described in the clause, normally with a premium more than you obtain at issuance, but let's say that the holder is required to sell when there is such a clause. Could be convertible in common shares. And it could come with a conditional voting right, for example, if the dividend has been suspended for a certain number of quarters. So let's look now at a classification according to the expected benefit. So we'll talk about blue chips, income stocks, defensive and anti-cyclical stocks, cyclical stocks, fast-growing stocks, and speculative stocks. I first have to mention that these are not mutually exclusive. You'll find that some stocks can very well belong to more than one category. Okay, first, the blue chips. Shares of large companies with assets generally in excess of 20 billion. So sales and profits are in constant progression, continuous and constant progression. We have an history of dividend payment that shows steady growth, no interruptions. And we're talking about major companies that have a strong position in their industries. But normally here you would not find cyclical companies. So if we have, let's say, a very large mining corporations, it will not normally be called a blue chip because of the cyclical nature of large mining companies. So we have examples like Disney, the Royal Bank, McDonald Co., CN, Loblaws. Here I can switch to just to give a look at CN. We look at the progression of the CN stock along the years. We're starting in 1996. And well, that's very stable. CN is one of the largest railway operators in North America, one of the 5 largest railway operators. So it meets the criteria for being a blue chips. Income stocks. Income stocks are common stocks that are not sought after for their capital gain potential, but for their high dividend yields. The effective dividend rate on the market value of an income stock changes constantly in direct relation to the general level of interest rates. Okay, here we can talk about BCE, TELUS, Canadian Utilities, National Bank, Procter & Gamble, J&J, Johnson & Johnson, TransCanada, AT&T, Fortis. Obviously, when we talk about Procter & Gamble, J&J, and AT&T, we're talking about blue chip as well. Even for BCE, for Canada, that would be considered as a blue chips. If we give a look at For BCE, for example, we can observe here that the dividend is currently 3.87 per share. That represents 6.3% annually. A word of caution, however, the most recent number for earning per share annually, trailing 12 months, is 298. So we can see that the earning per share is lower than the annual dividend. It's not a situation that could last. So there must be some reason to believe that the earning per share of BCE will increase substantially in the coming quarters. But the market has not lost confidence in this corporation. So we can assume that the investor, the market generally believe that the low earning is a temporary situation. Okay. Defensive and counter-cyclical action. So defensive stocks are stocks of companies whose profitability is less or not very sensitive to the general economic situation or to the general trend of the stock market as a whole. So here we can give, for example, Metro, McDonald's, Walmart, Uniselect. So if we give a look at Metro, can look at Fortis. Fortis is an income stock. For Fortis, the yield is currently 4.1%. And for Fortis, we don't have to worry because the dividend is $2.26 per year, and the earning per share is $2.70. So it's well covered as we speak. So Metro, here we have Metro for 5 years. We know that, well, September 1, 2020, we were at 69. In fact, if we give a look at when we had the pandemic, well, almost no, the stock didn't fall, almost nothing. And certainly when there was a reopening, the stock fell a little, but that's not that much. Here we see that we have a $69 price. It fell to 52, and it quickly rebounded. And well, so this stocks is very stable, okay? Not very much affected by the economy as a whole. Okay. Cyclical stocks. So cyclical stocks are shares of company whose financial performance is highly sensitive to the prevailing economic climate. These companies have much larger variations in sales and profit than the average company. So example, BRP, which is Bombardier Recreational Products, Rio Tinto, a very large mining company, American Express, a large bank, but that service mostly affluent people. And so when these people just cut back on their expenses, on their big box expenses, American Express will feel, will just be hurt by these changes. Okay, so if we look at their shares, BRP, so look, when in January 1st, BRP was at 67.56. A little later, the stock fell to $23, lost more than 50% in a few weeks because the pandemic look quite terrible for these type of investment or expenses. But after there was some monetary easing, the stock rebounded. Okay, so quite cyclical. Do I have another one? Okay, so then we'll go to fast-growing stock. Fast-growing stock. Common shares of growing companies, companies that have experienced in recent years a growth rate well above that of the average company, as well as by other companies in their industry sector. Intact Insurance, Waste Connection, Constellation Software, WSP Global, Alimentation Couche-Tard. We can also use a service that we find on Bibliothèque et Archives Nationales du Québec, BANQ. And this service is Value Line. I will just switch gear in the webinar to just demonstrate how you can use this very important financial service. But give a look. Let's give a look first at Alimentation Couche-Tard. So you see that's the stock of Couche-Tard since 1996. Very well, it was quite stable for many years, but since 2013, the stock has been increasing very quickly. Okay, how can we find these types of stocks? Let's visit the BANQ website, and I'll be using a particular service, which is an important financial service, Value Line. And we are advised that there could be interruption. And so there's not one right now. No, it seems that we'll be able to log on. Here we are. So Value Line, first you can look at a corporation either by using the name of the corporation or is a ticker symbol. So here, now I'm asking for information on Metro. I can see that, Value Line use a notation system with 5 degrees. The low degree is the most valuable. So and you have 1, 2, 3, 4, 5. And there's first a rating for safety and the second one for timeliness. So for safety, Metro is considered as having not the best safety degree, but the second best. Timeliness is just a rating that tells us, is the current price a good entry price for someone that has a medium to long-term investment horizon? Okay. So on February 3, so it's, let's say, last Friday, Value Line upgraded the timeliness of Metro from 2 to 1. And we see that in the industry, retail, wholesale, just 2 other firms have such, and Couche-Tard is the other one of the other one. Couche-Tard also have 1 as we speak. So I'll be using the screener. So I've clicked on Find Ideas, and I'll be using the screener, and I'll try to find some firms, Canadian firms, with a good potential for growth. So I'll ask a company that is located in Canada, we see that the system has 268 Canadian firms. And I'll be asking for firms with a growth rate, an annual growth rate for the next 5 years between 10 and 30. You could ask, why am I putting a cap at 30? Let's say that if the growth rate would be much bigger, that may indicate a degree of speculation that I'm not ready to accept. But you could do otherwise. Here we have 30 companies which growth rate, so earning per share annual growth rate between 10 and 30. We see that Couche-Tard is right there with 19.5. You have Bank of Montreal, you have Canadian Tire, Guardian, Leon Furniture. Most of these firms are in the Bourstad selection, in the list of securities that you can trade on the Bourstad platform. So, since I'm here, I may as well try another request. I would now request firms with a dividend yield between 3 and 6. So that could be income stocks on the Canadian market. Here we have 49. Again, most of these firms are in the Bourstad selection, or probably maybe all, but I have not checked, but maybe all in the Bourstad selection. Okay, let's go back to our presentation. Fast-growing stocks. The last category would be speculative stocks. Companies starting a company starting its activities in a very risky sector, or whose products have not yet passed the market test. Companies that have already been operating for several years in more stable markets, but which are nevertheless going through a period of financial difficulties whose outcome is uncertain. It could be the case of Revlon, a very large firm in the cosmetic industry that recently has asked for the protection of the law about the arrangement with the firm, the lenders. So it's a firm in a very critical situation as we speak. Oxley Cannabis could be a firm in this category. Let's look at the graph for Oxley. Maybe we'll go a little, let's look for 1 year. Just one year would be enough. You know, we were at 18 cents 1 year ago, and now we are at 3 cents. But if we go a little longer, let's say 5 years, the stock sold for $1.15 in 2018, and it's currently at 3 cents. So very risky. It's been removed from the list of the Bourstad stock because the price is too low. Indirect ways to trade shares. So you can go for bonds or convertible preferred shares. If you don't want to own the stocks, could go indirectly with bonds, convertible bonds or convertible preferred shares. You could also buy into an issue of bonds or preferred shares that comes with warrants. Warrants are a type of options that would enable you to buy stocks later at a fixed price until a specified delay has expired. It means that if you don't want to, you're not forced to require the firm to sell you the stocks. If the price is not interesting, you just put the warrant in the garbage can. It's over. There's no problem. But you have the protection of owning bonds or preferred shares and the additional potential of the warrant. Instead of owning the stocks, you could go with investment funds, either actively managed investment funds or the passively managed type, mostly exchange traded. Or you could buy options on the Montreal Exchange or warrants and or rights on the stock exchange themselves, because if you don't obtain the warrants on the market by buying a new issue, you could buy the warrant on the stock exchange, because those holders that don't want to keep the warrant, they just sell them on the stock exchange. A type of exchange traded funds, ETF, offered since 25 years. They are put into circulation by specialized firms and banks. A Canadian investor can buy funds on major Canadian, US, and other international stock market indices. This includes sectoral indices, funds of precious metals and commodities, bond funds from different type of issuers, international funds with or without currency protection, active or quasi-active management funds, balanced fund composed of several index ETF. A balanced fund will have part of a stock fund, part of a bond fund, maybe a money market fund, all mixed together. And you also find leverage funds. Leverage and inverse leverage funds will give you a multiple of the gain of the index, let's say twice or 3 times the increase of the index if it is a standard leverage fund. If you go for the inverse leverage fund, you will earn twice the fall of the index. So if the index fell, you win. If the index rise, you lose when you have an inverse fund. Okay, ETFs track their benchmark closely, guarantee of conversion into cash or again against a basket of securities. Here you have the wording of a clause for an ETF offered by BMO. Each trading day, unit holders may exchange the prescribed number of units or an integral multiple thereof for a basket of securities and cash. So with this type of provision, you can be assured that the ETF closely track the index it pretends to follow. Let's talk of dividends now. Dividends is the current income that the shareholder can receive in relation to his or her investment in the company whose securities he or she owns. Empirical studies have shown that dividends account for approximately 35% of the total return. So, dividend policies, fixed dividend policy, special dividends, and additional dividends, the rate of profit distribution as dividend, and firms can offer dividend reinvestment program. The fixed dividend means that a firm like Metro, for instance, has signaled to the market that until further notice, they have decided that they will give 30.25 Canadian cent per quarter as dividend. Most of the large firms on the market have adopted the fixed dividend policy. Okay, for a dividend, there are many days that you need to know. The registration date, April the 1st, for this Banque Laurentienne dividend. The ex-dividend date, it was March 30. Okay, so ex-dividend is March 30, but the last date you had to own the stock was March 29. You had to own the stocks on March 29 to effectively get the dividend. Those that buy the stock on March 30 do not get the dividend. And the payment date is May the 1st. In September 2017, the settlement time was reduced from 3 to 2 business days between the registration date and the moment you have to own the stocks. So now it would be ex-dividend on March 31st nowadays. But by the time this was issued as dividend, you had to own the stocks on March 29. Okay, a list of firms that give dividends steadily and they increase annually their dividend. So that the dividend growth streak, Canadian Utilities has increased the dividend for 51 consecutive years, Fortis for 49, etc. Okay, a few indicators. So that's the evolution of the 10-year bonds of the United States in the past years. Last year, there was a huge increase in the rate of these bonds. They started at half a percentage point, and they ended over 4%. Okay. The Canadian bond followed the same pattern. So you had half a percentage point by June 2020, and we saw it over 3.5 last year. The Toronto Stock Exchange lost 8.7% last year. The New York Stock Exchange lost almost 20% last year. NASDAQ, these are tech stocks, it lost 33% last year. The price of the Canadian dollar in US dollar increased. So it means that the Canadian dollar had a lower value at the end of the year than at the beginning of the year, because you had to, it cost you $138 at some moment last year to buy a single US dollar. The price of gold didn't budge much last year. It fell by less than 1% last year. Crude oil increased by 6.7% last year, but in fact, for most of the year, it was falling. From the summer on, it fell drastically from $120, and it finished the year a little over $80. If you want to go further, you can look at the AMF as a directory of financial education tools. If you have this PDF presentation, just click on the link and you'll go there. I mentioned a few publications like the Globe and Mail report on business section every day. It's very full of interesting analysis and information. Financial Post, that's the financial section of the National Post. You can find it on the B&Q Numérique press reader. Financial Times, published in London. Les Affaires, if you want to look at French language, economic information. Wall Street Journal, Value Line that we just showed. And maybe we'll take a few minutes to talk about Bourstad that you may enter, or maybe you have already entered the Bourstad 2023 Bourstad Challenge. So you act as a portfolio manager for someone that has entrusted you with 200,000 Canadian dollars. We have real-time transaction processing for 701 tradable securities and daily transaction for 36 actively managed investment funds, for which we get the quotation at 8 o'clock in the evening, and these trades are processed approximately at 11 p.m. So these securities are, we have the Bourstad portfolio. So these are 260 shares of Canadian company, 128 US companies, 26 Asian companies, 17 companies from Australia, South America, Africa, 41 European companies, 63 ETF of Canadian stocks, US stocks, international stocks, 39 ETF of bonds and money market funds, 17 ETF for alternative strategies. That means, let's say, leverage and inverse leverage ETF, commodities ETF, crypto ETF, and finally 6 currencies. But you have to take note that you manage your portfolio in Canadian dollars. You can own US dollars, but they cannot be used to purchase US dollar stocks. If you go into the Bourstad Plus portfolio, you have 100 additional securities. These are mostly options on the Montreal Exchange. So doing a trade in the Bourstad platform, that's something that I may do if you want. Here I am on my account. I create an account. Is it still there? No, I lost it. Okay, let's go for a trade on Metro. So Metro, we just looked at it a moment ago. The dividend is 1.6% annually. And if I look here at earnings, I see that there are 9 brokers with the target prices for Metro. They have target prices between $71 and $82 for a mean target price of $77. And today Metro closed at $69. So I'll go for a buy order at market price tomorrow morning. I want to buy 100 shares of Metro. Since it's my first purchase, I'll be holding 100 stocks of Metro after the trade has been processed. And if I buy it at $69, I'll go roundly here. Let's say that I'll be left with 193 and $100. So I'll be left with that money. My liquid asset will decrease because I have to pay for the stock. And Metro, you may be aware, is involved in consumer products. Okay. I'll be looking at making 1.7% as income. And let's round it with 8.3% as capital appreciation. If I sell at $75, that should do it. And we've looked at the mean target price of brokers is 77. So I'll play safe. I submit my trade. It will be processed tomorrow morning. Okay. A few features to manage your portfolio in Bourstad: investor profile, portfolio management, learning objectives. So investor profile, you have to specify what is the targeted performance as income per year and as capital appreciation for your investor. So when you add those figures, it gives you the targeted annual return. Risk tolerance, very weak, very great. Investment experience, very weak, very great. Investment knowledge, very weak, greatest. Total assets in Canadian dollars, total debt in Canadian dollars, annual income, investor profile, and you're set to go. Approaches in managing the portfolio. Will you be active, trying to beat the market, or passive, trying to just to meet the market return? Will you use a top-down approach, meaning that you base yourself on what is publicly available as information in the media? Bottom up, you may decide that you'll visit the premises of the firm or scrutinize the fine print on the very thick annual report. How will you allocate your capital among liquidity, bonds, utilities, financial services, consumer products, etc.? What will you want to learn in participating in Bourstad? You have automated portfolio management assessment, 5 evaluation measures, formative, and 14 summative that will be computed by the end of the Bourstad challenge. But these 5 evaluation measures, you will be constantly able to check how you score on these measures. Participants support a very extensive documentation system, information on securities, how it works, the rules, content, educational content, knowledge tests, information provided by our partners, Autorité des marchés financiers, CFA Montréal, Finecolab Games, honor roll, meaning that you can look at the list of winners of past edition. And here to the Bourstad Challenge contestant, that's where we put all the emails that we send to the contestants during the activity in case these cannot reach those we target with the emails. Okay, email and phone support, a Facebook page, weekly market comment on the Facebook page, also provided in the notification system. We will mention there the holidays on the financial market, publish the list of winners. In the challenge, there is a mentor, Mr. Gascon. He will apply a passive portfolio management strategy. 5 webinars, this webinar being the first one, but there'll be others. We'll come back on the next slide. The challenge starts on February 13 until February 26. You have the opportunity to define your investor, describe your initial management strategy, and your learning objectives. On one occasion, you can adjust your management strategy. On one occasion, in one operation, until March 26. From March 13 to March 26, we will administer the responsible investment qualification test. So that's when you have to pass to take the test. By April 14, 4 o'clock p.m., it will be the end of 2023 Bourstad Challenge. And in May 2023, we'll hold the award ceremony. Okay, responsible investment in Bourstad. I talked about the guide that you'll find in the documentation. In the portfolio management, you have to indicate if your investor is sensible to sustaining investment, and you have to indicate if you will take into account the extra financial risk, ESG. I talked about the online qualification questionnaire between March 13 and March 26. 40 questions, mostly objective questions, but 2 essay questions. We'll give further information on this during the challenge. Grand prize for responsible investment. First grand prize in the general public, that's $1,000. The prices for the general public, you'll find these on the home page of the website. Upcoming webinars, so February 16, next week, portfolio management in the Bourstad simulation. We'll have Miss Kelly Trehe from Trehe Finance, CEO of Trehe Finance, that will describe what is an active portfolio management strategy. On March 9, sustainable investment in the Bourstad Challenge with Mr. Michel Magna, professor at Concordia, and Mr. Thomas Estines, co-president of Responsible Investment Group. On March 14, Mr. Thierry Bourget will talk about challenges and opportunities in supply chain management. Mr. Bourget will deliver his keynote in French, but will make his presentation available in English. On May 1st, there'll be a webinar on career choices for graduate in financial services. Mr. Benoit Desgroseilliers from Finance Montreal will be there with other human resources specialists from our partners. The keynote presentation will be delivered in French, but the presentation will be made available in English, and the Q&A can also take place in English. I believe that I'm at the end of this long presentation. So the world of finance is an infrastructure that underpins human activities of various types. First, you have to determine your investment objectives. What is your target as return, capital safety, liquidity? You have to reflect on appropriate strategies based on your goals, your knowledge, your skills. You have to determine the degree of involvement in the management of your financial assets. It's important to continuously develop your financial literacy. You'll be learning how, during all your life, about how to invest money. And there are many possibilities, but when you start, caution is required.